Three friends. One man. Two women. All three are 30 years old. All three earn about $82,000 a year. All three invest exactly $900 every month. And all three make the same promise. By the time we're 66, money will never control our lives again. 30 years later, one of them has built nearly $2 million. Another has accumulated less than half of that. And the third is still checking stock charts before breakfast, hoping the next trade will make up for everything that came before. The shocking part? None of them worked harder. None of them earned dramatically more. The only thing that changed was how they invested. And if you've ever wondered whether day trading is really worth it, or whether buying and holding is simply too boring to make you wealthy, stay with me. Because before this video ends, you'll understand why the strategy that feels the slowest often wins by the widest margin. And once you see the mathematics behind it, you'll never look at trading the same way again. Hi, I'm Kaya. Today, we're not talking about opinions. We're talking about 30 years of decisions, 3 investors, 3 completely different strategies, and one result that surprises almost everyone. Let's meet them. Ethan believes the market rewards skill. If he studies harder than everyone else, reacts faster than everyone else, and spots opportunities before everyone else, why shouldn't he outperform everyone else? So every morning he's awake before the opening bell. Economic news, pre-market data, price action, volume, candlestick patterns. Nothing escapes his attention. Sophia agrees that simply buying an index fund feels too passive. But she doesn't want the stress of trading every hour. Instead, she becomes a swing trader. She studies trends, waits for momentum, enters positions for several days or weeks, then moves on to the next opportunity. She believes patience matters, just not for decades. Then there's Emma. Every month, on exactly the same day, she buys one low-cost S&P 500 index fund. No stock picking, no market predictions, no financial television. She buys, she closes the app, and she goes back to living her life. At first, Ethan can't understand her. "You're leaving money on the table," he tells her. "The market gives opportunities every single day." Sophia smiles. "Maybe not every day," she says, "but definitely every month." It sounds almost too simple. Maybe you're thinking exactly what Ethan is thinking. Surely the person making the most effort should end up with the most money. That's what almost everyone believes. And for a while, it even looks true. During the first 2 years, Ethan seems unstoppable. Some weeks he earns 4 or 5% while the others barely move. His phone fills with screenshots. His confidence grows. Every successful trade convinces him that he's developing an edge. Sophia performs well too. Not spectacularly. Emma? Nothing exciting happens. Her account rises, then falls, then rises again. Month after month, there is almost nothing worth talking about. If you looked only at those first 2 years, who would you bet on? Most people choose Ethan. And that's exactly why this story becomes so fascinating. Because the scoreboard everyone watches at the beginning isn't the scoreboard that decides who becomes wealthy. The first crack appears after Ethan's best year. He beats both of his friends. He even beats the market itself. For the first time, he starts wondering whether he should eventually trade full-time. "This proves it," he tells himself. "I've figured it out." But there's one number Ethan isn't looking at. One number that never appears in his trading app. One number that quietly grows after every winning trade. And by the time he finally notices it, it has already changed the outcome of the next 30 years. Because making money and keeping money are 2 completely different games. That number wasn't another winning trade. It wasn't a bigger market crash. It wasn't even another bad decision. It was taxes. Every time Ethan closed a profitable trade, a part of his gain quietly disappeared before it ever had the chance to compound. At first, it didn't seem important. A few $100s here, a few thousand there. But investing isn't won in a single year. It's won over decades. And that's where the math quietly begins to turn against him. Sophia faced a similar problem. She traded less often, so her costs were lower. But she was still trying to answer the same impossible question every investor has asked for generations. When should I buy? And when should I sell? Sometimes she was right. Sometimes she wasn't. The problem wasn't that she made bad decisions. The problem was that she had to keep making them. Emma never had that burden. She didn't need to predict tomorrow. She simply believed that the world's greatest companies would continue creating value over the coming decades. Every month, she bought another piece of them. Then she walked away. Now you might be wondering, surely a great trader can still beat an index fund? That's a fair question, and the answer is, a very small number actually can. Research has repeatedly found that a tiny fraction of professional traders consistently outperform the market. But here's the part almost everyone ignores. That group represents well under 1%. Yet nearly everyone who starts trading believes they'll be part of it. Confidence is common. Consistent outperformance is not. Then there are the hidden costs. Every trade has a spread, sometimes a commission, sometimes slippage before the order is filled. Each cost feels insignificant on its own, but after hundreds of trades, they quietly become another investor taking money from your portfolio. And unlike the market, those costs never have a losing year. 5 years passed. Ethan looked successful. Sophia looked disciplined. Emma looked boring. 10 years later, the picture had changed. Emma's portfolio was growing faster every year, not because she invested more, but because her money had begun compounding on itself. That's the part most people never experience. They're so focused on chasing better returns that they never allow time to become their greatest investment. 20 years into the journey, the gap became impossible to ignore. Ethan was still searching for his next winning trade. Sophia was still searching for the next trend. Emma had stopped searching years ago. Her strategy had become almost automatic. And that's exactly why it worked. By the time all three reached 60, they had invested exactly the same amount of money. But they did not arrive at the same destination. Emma finished with nearly $2 million. Sophia built a solid portfolio, but finished hundreds of thousands behind. Ethan, despite thousands of hours studying charts and following markets, had accumulated less than half of Emma's wealth. The greatest surprise wasn't the money, it was time. While Ethan had spent countless mornings watching markets open and evenings reviewing trades, Emma spent that time building her career, traveling, reading, and living her life. She didn't just earn a higher return, she kept something even more valuable: her time. And maybe that's the real lesson hidden inside this story. The market doesn't reward the person who works the hardest. It rewards the person who allows time, discipline, and patience to do the heavy lifting. So before you believe you need a more complicated strategy, ask yourself one question. Are you trying to beat the market, or are you trying to build the life you've always imagined? Because those are not always the same goal. If this video changed the way you think about investing, subscribe to the channel. Here we don't chase excitement. We build lasting wealth through timeless principles, one smart decision at a time.